Q&A live for Wednesday, September 28th. I'm your host, Dave Michalek. With me again, today's America's #1 credit expert, John Ulzheimer, formerly of FICO and Equifax. John, welcome back.
Yes, thank you. I'd like to change my title. I want to be America's favorite credit expert, not
We can do that.
America's. Yeah, let's do that for a while.
Let's do favorite. I like that because, I can see that being the case. If you look at everybody who's quoted you and all the publications you've been on and all the TV you've been on, I think favorite is probably... It is less subjective, I think, than than number one.
It's less arguable.
It's less arguable, yeah. If you ever had to, get questioned on that one in a deposition, it's like, no, listen, of course I'm the favorite.
Yeah. Look, I can't help what other people say about me.
Yeah, exactly. Okay. So, I was going to start off with, and for everybody who's watching, I know we just got a couple of people jumping in. Welcome. And the way these things go, this is all about you. Ask whatever questions you want, as long as it has to do with credit scores, credit reports, how credit works, how to improve your credit. We don't necessarily talk about credit repair on this type of a live, but you can always leave it in the comments if you're on Facebook, and I'll swing back around and answer it for you. But usually we start off by talking about a few things, like questions that come up during the week, usually on my part, whether it's posts on Facebook or YouTube, or sometimes tickets that we get inside of Credit Versio. And I'd like to start off with some of those, and then we just let it go and see what happens. See what people want to talk about. John, I thought we'd start off with the one you suggested earlier today, which I thought was a really good question. And let me know if I'm framing this right or saying this right. Are you more susceptible to identity theft if you have negative credit? Was that more or less the subject that you wanted to go over?
Yeah, it's an interesting. It makes you kind of think, right? Are you more of a target if you've got good credit versus if you have bad credit? How does a fraudster know whether you've got good credit or bad credit, unless they have copies of your credit reports? And then if you are ultimately a victim of fraud, what does that mean for someone who's got good credit versus for someone who's got bad credit? So that was kind of the concept, is kind of the nexus between the quality of your credit and identity theft, credit-related identity theft.
I love it. I think it's a great topic. I have an opinion on it, but I'll lay low and hear what you have to say.
Yes, I think we're going to run with this hypothetical that the thief doesn't have any idea what kind of credit you have. The thief is just a thief, and you have an identity, which is why we're all targets, because we have identities. And the thief goes out and procures our personal information, name, address, social, date of birth, somehow, and uses it to apply for credit. Now, here's where the issue of how does your credit quality interplay, here's where it begins. Because obviously the lender is going to pull a credit report, they're going to pull a credit score, they're going to determine whether or not the application is authentic. They may catch it at that point. They may catch the mismatch of things like addresses and personal information. You may have a fraud alert or a security freeze on your credit reports, and therefore, really, the process of fraud would end at that point, because now the lender knows or has a reasonable belief that it's a fraudulent application, and very likely was going to reach out to the consumer, especially if there's a fraud alert. They're required to take reasonable steps to ensure that it's an authentic application. And if it's a security freeze, obviously they're not even going to get a credit report back, because that's the benefit of a security freeze. But let's just say hypothetically that an application is submitted, a credit report is run, a credit score is calculated, and now we're in the underwriting stage of underwriting. So if a consumer has lousy credit, and an application is made at, say, American Express, well, the application is going to get denied because American Express doesn't have a subprime credit product. Yeah. However, if the application is made with Credit One Bank or any of the other various subprime lenders or lenders that have subprime products, then there's a possibility that it's going to get approved. So here's obviously where the problem begins, because now we have an extension of credit in your name. It's fraudulent. It's not really yours, blah, blah, blah. Now a thief is out there trying to max out the card as quickly as possible before everyone becomes aware of it and
Yeah.
and shuts down the fraud. The upside to having bad credit, if that's kind of an oxymoron, but the upside to having bad credit is you're unlikely to end up with a $30,000 credit limit on a credit card versus if you have really solid credit, then the lender is going to be more open to really throwing a large credit line at you because they feel comfortable that you're going to pay them back. Nonetheless, there's an extension of credit out there. It might be a very low extension of credit. And so that's obviously variable based on credit quality. So that's where the scenario may actually be helpful to you. The good news is that the Fair Credit Billing Act really places zero liability on the applicant or on the consumer for actually, it's not zero, it's $50. But the 4 credit card networks all have zero liability policies. And so as long as you, the victim, eventually report it to the lender, then there's going to be no money that comes out of your pocket. It may be inconvenient, it may be a pain in the butt to deal with it, but you're not going to lose any, you're not going to be held liable for any of the fraudulent use of the card. If things happen the way they're supposed to happen, meaning that you report the fraud to the issuer removes it from your credit reports, you report the fraud to the credit bureaus are supposed to remove the inquiries, and really you walk away clean. If that happens, you probably should place a fraud alert on your credit reports. You probably should you should probably freeze your credit reports now anyways, regardless of whether or not this has ever happened to you. And then it really will prevent it from, it's not going to prevent you from being a target, but it's really going to prevent anything substantive from happening if someone does try to submit an application in the name. As far as impact goes, obviously someone who's got bad credit already, something else added to their credit report isn't going to have as big of an influence versus someone who's got really solid credit. If something is added to the report, there's obviously more downside credit score risk. But again, that's temporary because of all these protections that consumers have. So it's kind of an interesting conceptual idea to kick around is, are you at greater risk or are you less risk? I mean, you could also make which is what the insurance industry does, is that the quality of your credit also kind of tends to define you as a person and how you tend to treat certain things. Are you more responsible? Are you less responsible? Employers, that's why they pull credit reports. They want to know if you have these other kind of incidents of irresponsibility, and is that going to bleed over into the workplace? So it's kind of an interesting dilemma that you run into as to whether or not you are more likely to do anything about it if you've got lousy credit, because you may not care about your credit because your credit reports and credit scores indicate that you may not care terribly, as much about them as you probably should. So it's kind of an interesting, topic to kick around. And I don't know that we've ever taken such a deep dive into it until we start talking about it.
This is a little bit of a segue, but I had a little smirk on my face because I happen to remember something from a while ago when you were talking about, and typically when I'm on by myself, I start the Facebook Live going over a few bullet points of importance. And one of them is that employers largely, about 73% of employers look at credit reports before hiring or promoting. And I think one of the things that skews that number considerably is government or anything that requires any kind of a security clearance.
That's right.
And so it's a very convicting thing when you think about it, that, hey, listen, there is a scribe that's been following us around for going back, 5, 10 years, 20 years or so, marking down and keeping a log of a lot of the decisions that we've been making, good or bad. And that's our credit report. And that's why I typically start out the lives by myself is, hey, this is your reputation report. This is your adult report card. We had report cards in school, so we were pretty used to it back then. But, we're not free of that when we become adults. There's another report card out there for us, and that's our credit report. But the thing that put the smirk on my face was an article I read a while back that was published by Match.com. I don't know if you're aware of this. I don't know if we've ever talked about this. But one of the subjects they brought up was the importance, like they had a list for women anyway of the top 10 things that were important when looking for a match. And in that. I think it was top. It was definitely 6 or 7, and that was
Mhm.
credit score.
Yeah.
And I thought that was really, now this is just stuff that they've done with their own internal investigation, but the article I thought was fascinating. That, like, yeah, it can even affect your dating life because it is kind of a red flag when you're getting with somebody and they're like, oh, by the way, I got a 475.
Yeah. No, you should run. What's that song? I don't want no scrubs.
Yeah,
Yeah.
right, right.
I don't know if you know this, but when I worked for Credit.com, I actually built a compatibility model, which was largely financial based. And I don't know what they ever did with it, but it was literally, what is important to you in a partner, and then based on the answers, then the would then essentially interrogate a prospective partner based on the
Oh boy.
qualifications set by the other prospective partner and whether or not you scored well in the compatibility aspect or if you did not score well. And so and certainly that was a pretty heavy component of it, which
Yeah.
was how well do you manage credit. And I don't know, you obviously have the ability to see this much more often than I do because you see credit reports so often, but I don't know if you have the ability to, and you may, I don't know how many of the Credit Versio users are spouses, and where you have both of their credit reports and scores over a period of time. But it'd be interesting to see if there is any kind of congruency between spouses as it
Yeah.
pertains to their attitudes towards credit management, especially after they get together. I mean,
Yeah.
certainly before they get together, people kind of take their own separate paths. But I can see, I mean, if you look at the reason why couples get divorced, it's things like infidelity and finances. So
Hmm.
certainly it's a huge variable in whether or not you can have a healthy relationship with someone else is how well they manage their money.
Yeah.
And I'll be straight up with you. I would have zero interest being with someone who has FICO scores in the 400s. That's just a very different person than
Yeah.
I want to spend time with, because
Yeah. And
that tells me a lot about them. And you know, responsibility obviously bleeds over into so many other aspects other than how
yeah.
well do you pay your bills.
Yeah. Well, I think even just to add a little bit more to that, it's how long are you in the 400s or 500s? What, maybe something happened. You don't know what the story is. If it's just gross negligence over years and years and years and years, well, that's one thing. If it's a blip in
Hmm.
time, something happened, medical, lost job, whatever, that might be a little bit different of a story. But yeah, I mean, it's the question is the awareness of that score and what got them there and what habits are keeping them in that situation. I think that's really kind of the root of what the real problem would be. Louis, good to see you. Satoria, welcome back. Mike is back. We haven't seen Mike in a while. Hey, David and John. As you might remember, I'm fixated on trying to get Delta Amex. My experience shows my bankruptcy from 2017, and that's the reason they won't issue. But is there any way to convince to look what I've done since then to get them to manual look at my credit? Okay, so like a manual review. I don't know. I don't. Do they have a manual underwriting? I mean, John, you're far more familiar with what goes behind or what takes place behind closed doors at a credit card issuer than I am.
Yeah.
Do they do any
Credit
kind of
card.
a manual
So,
review, or is it
so,
just like the
so
desktop?
yeah. So really, what Mike is asking them to do is to change their underwriting practices for him. And credit card, especially big lenders, don't like doing that because now you have inconsistency. Well, why did you do it for Mike but you wouldn't do it for David? Or why did you do it for Mike but you didn't do it for Stacy? And you better be able to answer that question to a regulator who's going to ask that question
Yeah,
about consistency in decisioning metrics. So the only like, it's easy for Amex to say no because they have like 50,000 or 50 million active users than it is for them to say yes because there's more downside for them to say yes.
yeah,
And Amex, like we talked about earlier, they don't have a subprime product. So other than the Bluebird prepaid debit card, which isn't really an extension of credit, it's like a plastic check. But that's the challenge, right? And you can that's what credit scoring systems do. They consider information that occurred in the past, and they consider information. Yeah, sorry, buddy. That's I mean,
Yeah,
the
let me put that
alternative.
up what you're responding
The
to. Yeah.
alternative, and I get it. We may get into it here for a little bit. The alternative is some lender pulling a credit report that's about that thick and flipping through it page by page and making a decision and expecting them to make a consistent decision time in and time out. So we're that ship has long since sailed.
How many active users did you say Amex probably has?
They're one of the largest, right? I mean, it's got to be 50 million if you take into account all of their business cards and the various
Mike,
products they issue.
Think about the underwriting, the epic underwriting job that would be for 50 million people if you had to manually underwrite every application.
Yeah, I mean, how many applications does American Express get a day? How many does Wells Fargo get a day? How many does Citibank get a day? How many does Chase get a day? How many does Navy Federal Credit Union get a day? I mean, the number is, there's a reason why there's 20 some odd billion FICO scores used every year, because it's a whole lot easier to make decisions that way than it is to sit there and print a credit report, which the Sierra Club is going to have an issue with, and sit there and look at it and, hey, what do you think about this credit report, David? Is it good enough or not? That ship sailed in the late 80s, really, when FICO scoring started being implemented at the bureaus. So,
and Mike, if you weren't here last week, John wasn't here either, but I told a quick story about how I learned about this initially when I ran F&I. I was an F&I manager for Saturn back in the day, and that was like our A paper went to GMAC, and we had a whole slew of C and D banks that would come in, and I had a rep, a really lovely lady named Aida, and she would come in once a week, and I would try to sell her my D and D minus paper. And I was very, I think it was probably 29 at the time, and I had this couple that I loved. They were such a great couple. I already had them in the car, and I didn't even have them financed, which is sort of a no-no. But you had a lot of faith in your alternative banks to find some funding. So I had this. So John, I don't know if I told you this story, but I had like a packet of info of stuff that they collected to show that, hey, we're back on time. This is what happened, and I'm like, awesome. I'm going to go to bat for you guys. So Aida comes in. I'm explaining this to her. She sits there, listens very quietly, with a smile on her face. And then she lets me get through a little bit of it, John. And then she reaches out. She puts her hand on my wrist. She says, David, let me tell you something. No bank is a story bank. And that was 20-something years ago, and I still remember it. So Mike, that's sort of like a roundabout way of summarizing why there's automatic underwriting and why it's not personal anymore, because the banks know that the story that they want is right there on your credit report. And you probably listen, there's exceptions everywhere. Like is the person who went through a negative credit event, like a bankruptcy 5, 6, 7 years ago, are they the same person today? Probably not. But you can't run a business off of probably. I mean, you can't run a business off exceptions. You got to run a business off of the rule. All right, so let's go on to the next question. Oh, you know what? Let's talk about this. And by the way, I see we got a handful of people watching. Feel free to jump in if you got a question about credit. Usually we have like a couple of faithful viewers, and then every week we've got 10, 15 or so brand new people, because we send out new invitations every week for people who got a new Credit Versio account. And listen, if you're hanging in there just to see what this is like, wonderful. Sarcasm, Mike. I wasn't trying to be sarcastic, man.
Sorry. Does that change the answer? The answer's still correct, right?
Yeah. No, I just like to put a kind of a
Mike
spin on
needs,
it.
Mike's in a emotional place right now. He's tired of computer systems judging him.
I get it. No, trust me. When I went years with my head buried in the sand, not wanting to apply for credit, I get it. I know where that comes from. But as I was saying a second ago, if you're brand new watching this, I see we've got a handful of people here. Probably never heard from you before. You can just say hello. If you got a question, drop it in here, and John and I will answer that for you. Another thing I want to talk about, John, is, and this has come up quite a few times in the last week or so, is people tend to get confused the statute of limitations versus what a time barred debt is and what those two different things are. and they're very different. So maybe you can take a second and explain what each one is, and explain why they're very different.
Yeah, this one, and this one is kind of a source for a lot of myths about, what
Yeah.
if should I dispute this, or is it going to make it stay on my credit report longer? Will I reset the clock, or is there anything I can do to reset the clock of credit reporting? I think this is one of those comparisons that is the source of a lot of those myths. The so first off, let's talk about the statute of limitations for the credit reporting of derogatory entries. And when I say derogatory, I mean like terminally delinquent accounts. I'm not talking about like a 30-day delinquency on your car loan from 5 years ago. I'm talking about, your charged off credit card or your repossessed automobile. So once it goes into that type of defaulted status, the credit reporting agency's standards indicate that the lender or furnisher has to include a date on the account or the trade line. And if you're a debt collector, then you have to include it with the collection segment. And that date's called the date of first delinquency, and the DOFD. And that DOFD is used to start the clock, the clock of obsolescence. And the FCRA indicates that clock is 7 years. And after 7 years, or before 7 years, that item has to be removed and it can no longer be reported. There's nothing in the statute that indicates that if you argue about it, or if you dispute it, or if you pay it, or if you ignore it, that somehow that can change that date. That date is the date, and it can't ever be legally changed. If it's illegally changed, meaning it's made more current for whatever reason, that is commonly referred to as re-aging, which is a no-no. There is no, you can't re-age, period. There's no scenario by which you're allowed to re-age debts like that. Unless you can correct incorrect dates, and that's not re-aging, but you can't change that date and make it incorrect. So that's that. So let's slide that off to the side. And now
one thing I just want to clarify there, John, too, because one of the things that it's a big misunderstanding when people are reading credit reports, and for those who are using Credit Versio or just any consumer credit report, a lot of people think that DOFD, that date of first default, is the date of last activity. So what happens when people are going through, whether they're disputing things or they're keeping an eye on their credit, when that last activity date updates to last month or this month when they got their credit report, people lose their minds. In fact, I just had a long email today from somebody who's like, "Hey, all my accounts have been re-aged," and they send a little screenshot of the date of last activity. That's not when things. Doesn't mean that things were reset to that date.
That's a reasonable interpretation of what happened, because
for sure,
that's not, I mean, if you're not knee deep in this stuff like we are, then that could be, you see these dates updating and you could freak out, and then walk away thinking that it's been re-aged, when reality is that it hasn't been re-aged. So that DOFD, that date of first delinquency, is really chiseled in stone, and it can't be changed unless it's actually wrong and you're just correcting it. And then, of course, certainly then it can be changed. So that's the statute of limitations for the 7-year clock for credit reporting. So let's talk about time-barred debt. Time-barred debt has nothing to do with credit reporting, okay? Time-barred debt has nothing to do with the 7-year delinquency clock for credit reporting. It is an entirely separate topic. Time-barred debt is it's unusual that in our industry the name of something actually means what it's intended to mean. This is one of them, right? So if you have a debt, now please, as I'm explaining this, forget about credit reporting for a minute, because I'm not talking about credit reporting. If you have a debt that has gone into default with some creditor, that creditor is going to try to collect it from you. And they're going to try to collect it from you using a variety of means. One of them could be suing you, right? They're suing you to collect a debt. Well, every state has a statute of limitations for how long a creditor can sue you to collect a debt. Once you have passed that date, that debt becomes time barred. which means they can still try to collect the debt from you. They can still send you letters. They can still call you, but they can't sue you to collect the debt. They can't use lawsuits as a means to collect the debt. It has become time barred. And if you look at every state, not every state, but the amount of time before debts become time barred, that the last time I looked, and I used to write articles about this a lot. I haven't written one in a while, but a lot of states have 3 years, and then some states it's over a decade. Yeah. So, and one of the questions I got from a consumer one time is, well, wait a minute, I live in this state now, but I took out the loan back X years ago and I lived in some other state. Which state applies to me? And I didn't know the answer to the question. And so I actually went to an attorney who represents debt collectors. And I asked him what state statute prevails here. And the answer is that, well, it's whatever state essentially governs the contract, meaning that if you took out the loan in Arizona, then it's Arizona. If you moved to Georgia, it doesn't matter. You took out the loan in Arizona and the contract was written in Arizona. So I think it really depends on what state you lived in when you took out the loan as to whether or not it becomes time barred. So so I get it. People kind of conflate the two as they're somehow related to each other, but they really have no relationship with each other.
One of the things too that people are under the impression, like, can you give a couple examples of things that, or maybe there aren't any examples, or one example, what can somebody do to reset that time bar, and what are things that cannot reset that time bar date?
Yeah, so it's my understanding that the time bar debt clock can be reset if you make a payment on the debt or you commit to making a payment on the debt. So what you will see sometimes is you'll see debt collectors ask you to make, like, goodwill. Just send me $20, make a goodwill payment. And I don't pretend to know what's inside the minds of hundreds of thousands of collectors that work for thousands of debt collectors. I mean, that would be stupid if I tried to do that. But you have to, if you're cynical, you have to presume that some of that activity is just to try to reset the clock for time barredness. So, or it could be something much more innocent, like, well, $20 is better than no bucks. And if you have the ability to pay me $20, maybe I can convince you to pay $40. So you may be a little bit of it. There may be a more kind of altruistic approach, but you also can take more of a kind of a cynical perspective and say, hey, you made the commitment, you made a payment, that clock is reset. So so that's my understanding. There may be other things that reset that date, but certainly making a payment or a commitment are the ones that I'm aware of.
Yeah, I wasn't even sure about the making the commitment part. I thought it was pretty ironclad that there had to be some kind of money exchange, or not money exchange, but some kind of payment made, like some consideration given in order to reset that time bar date. But you're saying possibly it might even be promising to make a payment?
The commitment to make a payment, yeah.
Interesting. Okay, that's good to know. That's really good to know. So, and I think
so this is one of the reasons this question comes up a lot from consumers who have collections on their credit reports that are unpaid, and they've, I don't know what the term is. They've seen the light. They have come into some money and they want to do right, and they want to pay the debt, and because maybe the debt has now been sold and now maybe a debt buyer owns it, so they can't go back and pay the original creditor because the original creditor isn't the creditor anymore. But nonetheless, they want to make a payment on the debt. And I get this question a lot from consumers is, should I make a payment on the debt? I owe it. And my answer to them is, look, if you making the payment's not going to cause it to remain on a credit report any longer. So don't worry about that. And if it's off of the credit report already, meaning that it's older than 7 years, making the payment isn't going to somehow make it go back on the credit report once it's already gone.
Yep, that's a big concern.
But what you may do inadvertently is if you go and start talking about making payments, is you may reset the clock of the time barred clock. So if you're going to do that, which I think is great because I think people should, I think people should pay money that they owe. I don't think that's an unreasonable position. Is if you're going to deal with a debt collector on an old debt like that, deal with it in such a way that you exhaust it. And you make a payment and it's done, meaning that you enter a settlement agreement with the debt collector and that's it. I'm paying you X% of what I owe you and you agree that it is zero. There's no more monies owed, or pay it in full, and then it's over from that perspective. But don't nickel and dime it, meaning, hey, how about I send you $10 for the next 5 years and then that'll pay it. Because really, like we talked about that, you've maybe just reset the clock of being time barred, and you really haven't done much to get rid of the balance. So there's kind of a strategic way of dealing with that. So you accomplish all of your goals, which is number one, you're doing the right thing by paying what you owe. Number two, you get the collector off your back, meaning that they're not calling you anymore, they're not sending you any letters. And then number three, there is no more balance, and so you don't need to really worry about any so-called time barred debt issues.
Yeah, going back to number two, and this is something that everybody should consider if we're talking about a debt that's considerable, and I know that's a relative term. Like, well, maybe you owe $1,000, $2,000, $10,000, $20,000. Just bear in mind when that debt is in the hands of a third-party collector, you don't know what they're going to do. You don't know what their business model is. Their business model might be to give you a shot at paying it off, and then listen, it's probably very cost effective for some collection companies to file a lawsuit on $3,000, $4,000, $5,000, $6,000.
Of course.
And John, as you've talked about before, if I'm a debt collector, if I'm in the collection business, and I have a portfolio of debts that I just bought from all these different original creditors, the first thing I'm going to do is I'm going to do a skip trace on everybody. So essentially, what I'm permitted to do is I can do a soft pull on their credit report. Correct?
Yes.
Okay, so I'm going to do a soft pull on the credit report, and I'm going to be looking at a couple of things. I'm going to be looking at I'm going to be looking at your debts. I'm going to be looking at your credit cards. I want to see if you got available credit. So I can determine pretty quickly what your financial situation might be by what's on your credit report. I might be able to find out where you work, and then I go, you know what, this guy, John Ulzheimer, not saying, John, you would ever have any outstanding debts, but like if you were on my hit list, a debt that you'd owe, I'm going to find out as much as I can about you. And then if I'm trying to work with you and it's not going anywhere, I might decide to file a lawsuit because I think that you might have adequate resources in order for me to get paid.
That's right. There's a reason why there's the mini Miranda obligation in the Fair Debt Collection Practices Act. The mini Miranda is, anything, and I'm paraphrasing it, but it's essentially, I'm so-and-so, I'm a debt collector. Everything that we discuss here, I can use in furtherance of collecting a debt. So I'm kind of caught between whether or not, so I'm definitely not a consumer advocate. I've made that point clear for decades that I'm not one of these people that automatically takes the side of the consumer without even considering anything other than that. I'm also not someone who just says collectors are always right and consumers are always wrong. That's silly. But there's a reason why you have a debt collector calling you, and that's because you defaulted on a debt that you owe. And so that the reason they exist is to collect debts. That's why they're called debt collectors. So they're not there to be your friend, just like the lady that you talk to at the F&I. When there is no such thing. The story is irrelevant. The backstory is irrelevant, right? So, and the faster you kind of come to that realization that they're not your friends, right? They're not your buddies. They're not your drinking pals. They're not your Facebook friends. They're your lender. They're your lenders, or they're debt collectors. Then the quicker you won't get your feelings hurt if they do things that are not congruent with what you think that they should be doing, what you would expect from a friend. is not what you're going to get from your bank or from a debt collector. So I try to be very almost Switzerland, kind of fair and down the middle on that issue. But to the extent that you can, I sat through I'm not going to name the guy's name, but he is especially in the Atlanta area, he's almost like a household name at this point in Atlanta. And he's like the consumer advocate finance guy who talks about how you can get cheaper cars and get your engagement rings cheaper than going to the mall. And that's his shtick. I listened to him speak at the Federal Reserve Bank of Atlanta one time, and this person, and again, I'm not going to, there's no point in naming him. He basically told hundreds and hundreds of people that you should ignore debt collectors always if they call you. Ignore the debt collectors, throw away the letters, ignore the phone calls. And I was like, oh my God. It's like, recipe for getting sued. Number one, ignore your debt collector, right? I mean, that's just stupid. The dumbest advice I've ever heard coming from someone who, purports to be a finance expert. So I actually take the very opposite approach, which is if you can't prevent it from getting that far, that you do start getting calls and communications from debt collectors, is, man, just start working with them as quickly as possible. You may be able to avoid credit reporting altogether, meaning that you may be able to work something out with them before they've even furnished it to the credit bureaus initially. And then at the very least, you avoid, because you know how it is, David. It's once those things are there, and if they're valid and they're not medical collections, those are kind of atypical. But if they're collections for things like apartment leases and other defaults, they're like napalm. They're next to impossible to get off of credit reports unless you take extreme measures, or unless it's really inaccurate or incorrect. But in my experience, it's, man, if you'll just work with them up front, as long as you start writing them checks or paying them, that's really what they want is that. And so I think you're going to get a much more pleasant experience, if that's even possible, working with the debt collector, if you're willing to do that. But ignoring them, in my mind, is not a viable strategy to deal with debt collectors.
Yeah. No, never again. And, it's something that I learned the hard way a long time ago. And that's the reason why, I'll get on here with everybody watching. And it's it's definitely against the grain for somebody in the credit consulting, credit repair space to distance themselves from everybody else who's on their YouTube channel or TikTok or whatever, saying never pay your collections, never talk to them, just like that consumer advocate or so-called consumer advocate said, because it's a recipe for disaster. Because I've been doing this long enough to see what happens when that takes place, and it's never a fun conversation with your client or with somebody that you're working with when they've ignored their debt, and then the next month, and here's why this becomes really important is, we can be in the first or second round, or they can be in the first and second round of disputing some accounts on their credit report, and then they get that knock at the door. And what they think is they think it's because they disputed it. But the fact of the matter is, a lot of times, law firms had decided to sue them probably months before. This was an inevitable thing anyway. And had they just worked with them, it might have been avoided altogether.
Yeah. Yeah, that's you can avoid a lot of things in life, but you can't avoid a process server. And once the process server gets a hold of you, then at that point, avoiding them starts to have true legal consequences. And Mike, you and I are in the same boat. I'm in Atlanta, and they're trying to terrify everybody right now. They've moved all the high school football games around so that they don't happen on Friday night because of the hurricane. So I don't know what's going to happen this weekend. I guess at the very least, we're going to get some rain.
Yeah, I've got we've got some people in some partners, Versio partners that are in Florida, and I was talking to one of them yesterday, and she's like, she goes, she's got the I forgot the national weather alert beeping on her phone while the two of us are having a conversation. She's like, I'm going to stay on here as long as I can. She goes, but, husband's in the background packing everything up. We're not sure exactly where we're going to go. And so, it's a little dodgy out there, Mike. So, stay safe. Okay, where are we? About 40 minutes in. Anybody have any questions? I hope we didn't lose Mike there. I'm not sure why he thought we were being sarcastic. It was just, telling stories the way things were. But You're in Tampa. Oh yeah, yeah. Well, Mike, I thought it's starting to head up towards Tampa, isn't it? Because that's where my partner was in Venice, so I think that's not too about an hour away from Tampa, hour and a half away, something like that. It might be a little south of you guys. I'm not quite sure. All right, so anybody jump in with a question? If you got it, we'll hang out here for another few minutes or so. Meanwhile, um, another thing, John, that I was talking about recently with a Credit Versio subscriber was, I mean, they had these real deep concerns about accounts, and it's like, hey, listen, this is on my credit report for 7 years, and that's a long time, and is this stuff going to curse me for 7 years? And you're going to give your answer, and my answer is pretty much going to be the identical answer as yours. But I thought maybe talk a little bit about the impact that derogatory credit has, especially over the first couple years, and ultimately, what does that 7 year mean, and how does it affect people over a protracted period of time until it eventually falls off?
Sure. So if I had the ability to draw a chart, I would draw a chart right now, and the chart it would basically be a kind of a bar chart that would indicate the relationship between negative information on a credit report and the likelihood of somebody paying future accounts late over a period of 7 years. And what you would see in the bar would be that after year one, which is where there's the highest amount of correlation, it starts to actually go down year over year, and then after 3 or 4 years, it's actually fairly low. And so what that and where that chart would come from would be, and I, when I was at FICO, that was one of the charts that we would use when we were kind of explaining why derogatory entries have an impact on a score, why high utilization has an impact on a score, why excessive inquiries has an impact on a score, is because of this correlation between the activity and elevated credit risk, which is the answer to every question about, well, why is this hurting my credit? Well, there's a relationship between that and credit risk, and so that's why your score isn't as good, because of that relationship. And what you'll see is, and this makes sense when in practical terms, when you look at a credit report, if it's got a bunch of delinquencies that are a year old, your score is not going to be as good as if you have the same delinquencies that they were 5 years old. Then your score is going to be better. Even if you did nothing, even if you didn't try to rebuild your credit, you just put time between yourself and the negative events. And so that's why you start to see your scores improve even over a very short period of time, 12, 24, 36 months, because you're starting to essentially put that amount of time between yourself and the event such that the event is less predictive of elevated risk, and therefore the weighting of that is going to be less in your score. Now, if you default on something, it's a little bit older, and then you default on something, you're essentially, now you have another brand new default, and then you let it age, but then you default, so now you have another. So really, you're never allowing time to occur between you and the event. So you always have something on your credit report that is highly correlated with elevated risk, and you're not giving it time to age and go away such that that correlation goes down, and therefore your scores go up. That's why it's, whenever, I did an interview today with, I can't remember who, Market Watch, and the guy was insistent. Well, how long does it take to increase your score 10 points? How long does it increase your score to increase 50 points? And I was like, bro, seriously, stop asking me the damn question. I can only answer it so many times. You can't answer that question. There's no way. If you interview someone who gives you an answer to that question, you're interviewing someone who doesn't know the answer to the question, and they're guessing to get you off the phone. There is no, because you don't know how old it is, what the balance is of it, what else is on the report. You have there's too much backstory or context missing to be able to say, oh yeah, a year, 24 months, which would all be incorrect answers, because you simply don't know. So that's the issue with the amount of time it takes to rebuild credit, is because some people have that kind of stuff, but it's 5 years old. So their path to recovery has largely already taken place. And really now they're just kind of finishing the icing on the cake, versus someone who has that kind of stuff that's less than 12 months old. And they're really on the front end their credit building journey. So one of the questions that Mike had in one of his questions from earlier was about bankruptcy from 2017. I don't know what month it was in 2017, but that's 5+ years old, maybe. So the effect of that, assuming that there isn't anything more recent than that, if you kind of correlate his question to that, that hypothetical bar chart that I was wanting to write, he's on the tail end of that bar chart where the relationship between the BK and risk is much lower, unless there's other stuff that's much newer, and then of course, then all bets are off. But that's generally what you see, and is the answer to why it takes some people so long to improve their credit, while others it takes much less time, even though their credit reports kind of look similar in just the incidence of defaults and collections that are on their reports.
Yeah, I've told people before that I've seen in all the tens of thousands or 15, whatever it is, 15, 20,000 credit reports I've looked at over the last decade. One of the things that surprised me early on was those people who, and they were business owners that filed bankruptcy, and their bankruptcy was 5 years old, 6 years old. So, it's sort of at that tail end of that chart, like you were talking about, and their credit scores were in the mid to high, usually not the high 700s, but 750, 760. I mean, they were really, really good scores. And that's because they had this it's like a pig through a python, and it's moving, through that python. It's just all the same stuff that continues to get older and older and older. And then all the newer stuff is relatively well managed, low credit card balances, nothing derogatory. So, people think, oh, bankruptcy. I'm cursed for 10 years. If it's a Chapter 7, I'm cursed for 7 years. If it's a 13, and everything else that's on there, I'm just going to have to live with it. But like you were saying, the reality is that we heal over time. And it seems like a lot of the score is really predicated on, John, like we've talked about this before, is trying to determine what's the probability, what's the likelihood of somebody having a major derogatory in the next 24 months. So it seems like like FICO and VantageScore both somewhat have like a 24-month memory where they really just want to know what's going on, largely in the last 24 months to predict what's going to happen in the future. Is that largely what the credit scores are trying to do?
So let me tell you where that comes from. This is a little bit of a history lesson with respect to scoring. So think about all the types of lenders that use credit scores: mortgage lenders, auto lenders, credit card issuers, boat loans, motorcycle loans, student loans, utilities. So think of all the different extensions of credit where your score is relevant. So from a smart business perspective, it is better to build a scoring system that is generic enough that it can be used across all of those different loan and credit related scenarios, if you will, versus building a credit score that is optimized to predict things like the likelihood of defaulting on a credit card in the next 6 months. That may be great for a credit card issuer, but a mortgage lender isn't going to use it. An auto lender isn't going to use it. So whatever score you build has to be generic enough that it can be used across all different portfolios and all different points in time during the management of existing accounts. So if you look at the peak default rate for credit cards, it's going to be different than the peak default rate for mortgages, which is going to be different than the peak default rate for auto loans, which is going to be different, blah, 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 et cetera, et cetera. And so you have to build something that predicts the likelihood of default or serious delinquency over the next X amount of months that is relevant enough to credit cards, auto loans, mortgages, et cetera, that lenders in those industries feel comfortable buying and using that score. That's where 24 months comes from. There's no secret as to where 24 months comes from. It's just so that the model is generic enough that it can be used across all different types of credit-related decisions, and a lender feels comfortable with it. If you built a credit scoring system that predicted the likelihood of you defaulting in the next 7 years, a credit card issuer is not going to use it, because credit cards don't default. The peak default rate for credit cards isn't 7 years. It's much, much sooner. So that's where the 24 months comes from.
Got it. When you say rate, you mean timeline, like when the peak timeline is for default.
Yeah. So if you look at credit card defaults, right? So X% of credit card defaults occur within the first 6 months. Y% of credit card defaults occur between months 6 and 12. Then between 12 and 24, then 24. So you can look at an interval distribution of defaults for credit card accounts, and you can see, look, the peak default rate for credit cards occurs between month this and month that. I don't know what it is off the top of my head, but it's definitely not 7 years. I can tell you that.
Right.
It's much earlier than 7 years. So you have to build a score that predicts the likelihood of somebody defaulting at almost the peak default rate, because that's really what I care about as a lender. Is I want to know the likelihood of somebody not paying their bills on time, but I want to know before they default. I don't want you to tell me that the likelihood of you defaulting in 7 years is X when my peak default rate is in 8 months.
Right.
So the score is not applicable for me at that point. So therefore, I'm not going to buy it from a credit bureau. I'm going to buy something else or have something custom developed for me. So that's what I mean when I say generic enough that it's applicable across all default rates for different types of extensions of credit. I can tell you that the term generic is not a term that is a favorable term, but to me, that's the appropriate word. It's vanilla enough to where it can be used across all different types of lending, and the lender still feels good about paying for it and utilizing it for underwriting.
Why don't we wrap? Great answer. Why don't we wrap it up with Mike's question here? Have you ever covered the resiliency score?
I probably have. If I have, it was forever ago when it first came out. For those of you who don't know what that is, FICO, it's either called the Resiliency Score or the Resiliency Index. Mike may be asking about it now because of the economy that we're in. Essentially, what the Resiliency Index is, it's a product that, and if you can Google it, and FICO probably has some product information about it on their website. Basically, it's a score that lenders can use to determine how well you are going to react as a borrower to the current economic scenario that we're in, right? And so, right, I'll give you a great example. So, and I'm not saying this is what the Resiliency Index considers, but I can lose my job tomorrow and my FICO score won't go down 1 point, but I can't pay my bills next month. Whatever my score is, isn't really an accurate reflection of how I'm going to start acting, because you have no idea about what my income is and how resilient I may or may not be to the current economic environment. And I don't know if people are losing their jobs left and right now. I'm not an economist in that respect, but that's what the Resiliency Index is it helps lenders to understand how well their customers are going to react to things like a bad economy.
Yeah, interesting. I'd love to dive deeper into that at a later time, because it sounds like we're talking about trended data and maybe some other things that are not typically what we discuss when we're talking about credit scores, but I'll have to do a little bit more reading on that. All right. Well, we're at the 53-minute mark. Man, that flew by again. Thank you so much, everybody, for joining me and John today. I appreciate it. And John, thanks again for participating. Great answers to all this. Love it. So thank you, everybody, for joining us today. And we will be back, or I'll be back next Wednesday. All right. Take care. Thanks again, John.
Thank you.